Welcome to the April 6th Advance Report for McGowanGroup clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman through the storm and president, McGowanGroup Asset Management. A busy week coordinating with clients, getting the updates to you, and we'll give you a fast-paced tour of the key data that the markets will be looking for as the worst case estimates came all week long. Unemployment, forecasts of what would happen to GDP and what would happen after. In this weekend's program, we cover one of the most credible forecasts saying, okay, unemployment will reach 15% and the GDP will be down. Economic growth will be a shrink of 1/3 temporarily, and then the fastest recovery in history. We had used that language before, and we begin to see how that can unfold and the best ways to position and take advantage of where we are right now. Nobody was unscathed from the current crisis, and prayers for you and your family, good health, and prosperity restoring, we hope, this summer. So let's take a look at where we go from here. Well, the Dow Jones Industrial Average completed its correction from the euphoric highs priced for perfection at 29,568. The low point was near 18,000 as the markets instantaneously adjusted for this setback. We're getting more intelligence on commercial and residential real estate that market is poised to resume, but temporarily shut down, of course, with no buyers. And that's the state of the financial assets as well. You can see the rebound, which was 23% from this low point, and had a little setback, closing the week at about 21,800 or thereabouts after a Friday decline. What does this mean? Well, you have a new trading range, 18,000 to 29,000. How long would it take to get back to 29,000? In 2008, the bottom was actually March 9th of 09. It took 27 months to see the same levels restored. But there was a faster way to recover, and I believe the mathematics is correct in the current markets, and we'll cover that later in this week's broadcast. This is the interest rate market. Now the T-bills briefly went negative, about 0.1% negative. That means that the markets were poised to charge you, the banks and the institutions and the Treasury were poised to charge you for simply holding cash. Well, this week that returned to a more normal 0.06% when the cash interest rates are zero. By May, you'll see most money markets at zero, and some of them actually below zero at an institutional level, charging people to hold safe cash. What does that do for the markets? Well, the net present value of future cash flow when interest rates are zero, future cash flow is worth a lot more, especially when you're in deflation briefly. Now, the 30-year Treasury, right at 1.25%, the 10-year Treasury just below 0.6%, meaning that there will be mortgages below 3. It hasn't happened yet because most banks are on minimal staff at the current time. But the interest rate picture says this could stay low for an extended period. Right now, if you looked at where does this thing begin to turn in terms of financial assets, this is the key number. This week with ubiquitous testing, and here next to the Crescent at American Airlines Center, they were testing all day long, all week for the COVID-19. You actually had a line, people stay in their cars, the Dallas police supervising it. So we know that testing is rolling out ubiquitously when it used to be just people that were about to be hospitalized. This number actually showed signs of peaking a couple of times, but with the ubiquitous testing, the number of cases per day, the number of new cases. Texas actually got good news on Friday. The number of new cases did drift down a bit, but you can see with ubiquitous testing, this number is actually what most traders and portfolio managers are looking at from Johns Hopkins at their website. If you Google Johns Hopkins coronavirus or simply go to networthradio.com, the link is there. On the US, if you click US and click daily cases, you'll see that this is the number that the financial markets are responding to right now. The big question was 18,000 the bottom. Well, you could build in the fact that that reduction of near 40% from the peak actually does build in an extended recession, and we're not sure that's the case here. So what is the solution? Well, we always come back to fixed income. The only right answer this year was treasuries and cash. But for the assets that pay more than that and have a much brighter future in terms of return, this is the US B-rated market. That's like if you look inside most banks, loans and bonds, an average credit rating of B. You can see in the crisis, those bonds went from a premium 106 to a low of 62 during the real estate and bank-driven defaults. There were 10 to 15 banks failing a week back in 08. It was more of a systemic, dangerous market than what we have now, actually, if we look out into the third quarter. As a matter of fact, the source we're using for economic data says the third quarter could show 19% economic growth coming out of this. And when is the containment mitigation period over? Well, April, if it brings the reduction in the number of new cases daily, then we could see something extraordinary. Here, you adjusted for a depressionary default rate back there and right here. That's below 70 cents on the dollar for short-term loans and bonds in the open market. Well, what does that mean? Well, if par is 100, that would be a 30% default rate. The default rate in the Great Depression was about 20% by the sources that we have. And what it means is baskets of great fixed income, which now are available paying over 10%, in many cases are priced below 30 cents on the dollar for well-managed portfolios. That's how we recovered very quickly from 2008 in 2009. I've been sending that update to clients because here's what we accomplished. Using these two funds, baskets of high-yield debt, we actually were able to secure more par value under control. We reinvested and added to them at this period. And what was the 5-year result? That's 2007. That's the temporary setback in the crisis. That's a very rapid recovery in two of the cases above where they were before the crisis. Why? Interest rates were zero. If you've got something paying over 5%, you may have a great asset that you don't want to turn loose of. You may want to add to it when the discounts are that extraordinary. And that's exactly what we're seeing right now. It was the solution in 2009. After 2009, because we secured record income, we had 5 years of average double-digit performance for the group of clients as a whole. And that's the leadership message that I bring you today. In fact, from before the crisis through the end of 5 years at 2012, this was compounded at 14%. So the dividends you can reinvest should be reinvested. And here, the average was 10%. Well, imagine the assets if you gradually added to it through reinvestment. These returns of 10 and 14 are possible coming out of this. And of course, we have a major source with deep economic knowledge saying, then the fastest recovery in history. When the number of cases reported per day begins to drop, you're likely to see how that stages in with containment and mitigation. I'm Spencer McGowan, President, McGowan Group. Come see us at the Crescent and call anytime. We've been scrambling to make sure every call gets answered. We are here for you through the crisis. Thank you for tuning in to our YouTube channel. I'm Spencer McGowan, President, McGowanGroup, your financial weatherman. We sponsor each week NetWorthRadio.com broadcast that has the charts and graphs, many of which you saw today. We also sponsor this YouTube channel. Be sure to subscribe for fast-breaking news, an alert when we post something in a market condition that may have changed. Our goal is to help you as an investor make the right decisions at the right time. And that's part of what this YouTube channel is about, as well as NetWorthRadio.com. I am well served with a team of 10 people, including myself. And that team that cares is actually made up of people who devoted to your net profits and your success, as well as excellence in service. If you want an educational experience to follow this up, get to NetWorthRadio.com, the McGowanGroup.com. Right here, we disclose our net client experience all the way back to 2001. What that includes, the bear market cycles of 02, 08, 2018, and the recoveries through the most recent quarter. That is true education of investors and exactly how our clients have done, disclosed right here. Further disclosures, value at risk of loss. Yes, investments are going to fluctuate. That's part of the reason for this broadcast. And that can actually work to your advantage. We'll build that into your plan. So I urge you to go to NetWorthRadio.com, fill out the preliminary client questionnaire, a free 1-hour brainstorming session by phone or at the Crescent in Dallas, and we will map out a multi-year plan for you and your family that's appropriate. Just because we talk about a security on this broadcast or any securities doesn't make it a recommendation for your portfolio until you have that written plan. Thank you for tuning in today, and we'll be back next week as your financial weatherman.